Muy bien, bienvenidos todos a un nuevo evento de Value School. Estamos aquí este jueves con un evento gestor, y además un evento gestor internacional y de altura, como es este con Gary Channon, gestor de Phoenix Asset Management. Antes de dejar a Gary que haga su parte de presentación, me van a permitir unos breves minutos para comentar un par de cosillas sobre la actividad de Value School y también, como un heads up, un friendly reminder, este evento va a ser en inglés, ¿de acuerdo? Pueden hacer sus preguntas también. Vamos a tener al final una sesión de preguntas y respuestas con nuestro entrevistado y pueden hacernos llegar sus preguntas, si así lo prefieren, en español y nosotros se las transmitiremos también en inglés. Respecto a Value School, recientemente hemos publicado 2 libros nuevos, que los tengo por aquí. El primero de ellos es El archipiélago liberal de Chandran Gukazas y forma parte de nuestra colección de Economía y Política que publicamos junto con Deusto y con el Instituto Juan de Mariana. Justo ha sido presentado el día de hoy en Libre Acción y el segundo de ellos es Las 5 reglas para invertir en acciones con éxito, de Pat Dorsey, que es parte de nuestra colección de inversión, también que publicamos con Deusto, y le hemos reservado una fecha muy especial para realizar aquí un evento de presentación que pronto verán y podrán acceder también a él para apuntarse y asistir en directo. Y bueno, también comentar de estos 2 libros que para acercarles a ustedes su lectura vamos a habilitar unos sorteos durante la próxima semana, así que pueden participar en ellos acudiendo a nuestras redes sociales en Twitter, en Facebook y en Instagram para poder ganarlos. Y también, si nos estás escuchando, a ti desde casa y a vosotros también, y tenéis entre 18 y 25 años, actualmente, como bien sabréis, tenemos abiertas las inscripciones hasta el día 2 de junio para participar en la que puede ser una de las mayores oportunidades para la carrera de un joven interesado en las finanzas y la inversión, que es nuestra escuela de verano. Este año vamos a tener 2 ediciones, una del 24 al 28 de junio y otra más que va a ser del 1 al 5 de julio, y os podéis apuntar y ver toda la información relacionada con la escuela de verano en www.valueschool.es/escuela-verano-2019. Y bueno, no voy a extender más, voy a presentar a Gary y ya a partir de aquí vamos a empezar a hacer todo el evento en inglés. So, Gary, I'll start introducing you, and then you may start your presentation and we'll do the Q&A part. Gary Channon co-founded Phoenix in 1998 and has been the chief investment officer since its inception. Gary's investment approach at Phoenix is long-term, value-based, and focused. He looks out for businesses run by competent, honest managers who act in the interest of shareholders. Ideal companies have strong pricing power to generate an enduring high return on capital. Gary identifies great companies with good management and waits for the opportunity to invest in them at attractive prices. And Gary, I leave it to you from here.
Thank you.
Thank you very much.
Okay. If I speak too quickly, please stop me. He said I founded Phoenix in 1998. So I had an epiphany in 1995. I was working in the city. I was looking for a stock picking methodology to put into what were pretty much quant models that we were using, and I was vaguely familiar with the idea of Warren Buffett, but didn't know very much about him. I read the Roger Lowenstein book, and I had an epiphany. So that was 1995. I then used Nomura's money to practice value investing, and then when I thought I knew enough to start, I left the city in '97, and Phoenix officially launched in '98. So this is us today. We manage £1 billion. We're based in an office just up. We started in my house, and then when we got to 4 people, my wife kicked us out, so we've moved up the road. But we're still within walking distance of my house in southwest London. There's 14 people. About half are in the investment team, and half are in the what we call the business team. Excellence is a strong word. I think we have a good track record. I'll show it to you. We have a specific approach, which is, I think, slightly unusual from a lot of value investors. So a lot of these things just look like everybody says this: buy great companies, ignore the market, buy them when they're cheap, hold them. But the thing that's probably quite different about it is the way that we monitor our companies. We're obsessive in the way that we monitor our companies, the level of detail, how close we get inside companies, and maybe we'll talk about that a little bit later. So Yeah, I had something yesterday. I had a company asking us to desist. They didn't know whether we were short sellers or investors, but one of my analysts has been looking to set up a franchise. So we have been going through the motions of setting up a franchise as a way of understanding more about this particular company. But that's the sort of thing we do. But the rest is like everybody else. So our track record is like this. The first line is the gross and the one is net. Depending when you pick, we ebb and flow. But I would say roughly we've had about 8 points of alpha when you pick a mean point. And then depending on which fund, this is the UK fund, we have different charging structures for what the net return is. So all of the drawdowns that we've had that are significant, that have been more than 20-25%, we've had 4 of those. They've all reversed within 12 months. So all the times when we've looked the most ugly is actually when we've been doing the best work. So all of those drawdowns have been sort of painful from an external point of view. The NAV's been falling, but they are our most active times. So we do catch falling knives. We do buy the ugly when it's looking extra ugly. But all of the future performance comes from that activity. And we've all the way through, I've invested as if all the investors would leave tomorrow. So I've always thought I'll invest with my own money. I'll try to explain, but I never listen to what investors say to me or do what I think will be attractive for investors. And fortunately, we've managed to find the right sort of investors, and they've stuck with us. A big part of what's happened about the way that we invest is what we call strike ratio. So how often we get it right versus getting it wrong. And we measure it in 2 ways. One is just the number, and the other one is value. So by number, we get it right about 80% of the time. So for every 10 investments we make, 8 are profitable and 2 are unprofitable. And when we do it by value, in terms of how much we make versus how much we lose, for every £10 of gross return, 9 of it is profit and £1 of it is loss. And that's a very unusual ratio when you compare it to other managers or the market's about 55-45. And I think that comes down to the work of the investment team. The thoroughness of the research either stops us making the investment in the first place, or we spot our errors early. And then the actual decision and portfolio weighting is down to me. So I think with that level of strike ratio, we should have made a lot more money. So the translation of that research effort into a portfolio construction through me lost a little bit. I think our alpha should have been higher. But it's got better through time. And that's the current portfolio. This is unusually flat. Typically, the top 5 holdings, we've averaged about 15 holdings. We've never had more than 18. We've never had less than 12. But we have had, typically, the top 5 would be more than half the portfolio. But right now, it just happens to be unusually flat. And again, most of the holdings are profitable. So, I mean, in terms of my story, I think it's probably more going to come out through. Are you going to do an interview now? I've kind of explained our past, where we are, and what our track record is. You think I can keep going? Okay, so I'll tell you what I did. So it was really a presentation that we would do to investors, but I changed it. I've changed it in the hotel room about an hour ago. And so what I've changed it to is, if I was sat there, what would be useful for me? So you know all the usual things. If you know about value investing and been studying value investing, there are things that are talked about a lot, like how to buy and the sort of companies you look for. And there are some things that aren't talked about very much. And I thought I would tell you my personal perspective. So just there's 8 things here. One is team. So at the beginning, a lot of people think, I'm going to do it on my own. Do I do it as a team? And I get asked it when I do some mentoring for people. Shall I just be on my own? Shall I have analysts? And it turns out, when I was first asked that question, I thought about why I had analysts. It was actually an accident. I always imagined it would just be me. And then when we were full, my partner started a fund as well. So he hired a couple of graduates, and he had a team. And he ended up not being brilliant at the fund management, so I had to ask him to leave. And then I had a couple of graduates, so I sort of used them. The other thing is I'd hired somebody to help me with the admin. She was so good at the admin, she was an accountant, It only took her like an hour, what was taking me all night. So she was sort of available. So I started using her as an analyst. And so I ended up with a team of people kind of by accident. But actually, it's been wonderful. Phoenix is a much better organization as a result of being a team. So I always think of that as like the best decision I never actually made. It sort of happened to us. So the reason why it's been good for us is once you start working beyond yourself, you need a system. And you need a system as yourself, but quite often people do that in their head. And they do it with the way they diarize or the way they organize themselves. But continuous improvement, which is a lot of what we do, I think we've got better and better through time. It gets harder to get alpha with more money, but our alpha has gone up with time. And so that means I think our skill has gone up a lot more than actually shows in the alpha, because we're doing it with larger amounts of money. And that has come from being a team, having a system, and being able to continuously improve. So let me just explain what I mean. So once it was me and Charlotte, we had to say, well, hang on, this is a good company. Well, yeah, but is it a great company? Well, what do you mean by good and great? Or let's score it out of 10. Well, I'll have a 10. I'll have a 9. Well, she never gives anything a 10. Well, then your score is not 10, it's 9. So you can't have those conversations. We realized we needed a framework. So we developed a framework for how we would think about companies. Also, how do we compare Unilever to Hornby? So we developed a system. We call it DREAM. But essentially, it breaks down that business management price into lots of little subcategories, and then we calibrate them, 1 to 10, 5 the average company, 3 to 7, and we weighted them. We've used the same system for 20 years. We've never changed the weightings, we've never changed the factors, and in the manual has evolved as we've applied it. It's about 100 pages, but it makes you think about every factor in the same way, and we rate the factor, we rate our confidence, and we rate our depth of work. Because otherwise, what happens if people haven't done any work, they tend to put a low score. And they say, no, get the score right, and then say, I haven't done much work, or I'm not very confident, but try and get the score right. So once you have a system, then you're all talking the same language. And you've got something written down so that you can learn. When you get it wrong, which you're going to do a lot, well, then you've got something to go back to, and not just say, well, I said it was good and it turned out to be bad. It was saying, well, I said it had pricing power and it didn't have pricing power. I said it's got a strong market position and it's lost a strong market position. So by breaking something down, I don't know if you've read the super forecasting book that I think you recommended last week or whatever, then you'll see there's something called Fermi estimation. So Fermi realized you could get much better at estimating things if you've broken them down into manageable chunks. And I suppose that's what we do. We don't try to say, is it a good company? We say, does it have pricing power? Does it have a high return on capital? And we break it down into those chunks, and then you put them all together, and you get a much more accurate assessment. So we developed a system, and then we observed whether the system worked. You say, well, does that look right? And then what happens in reality? Well, then you learn whether your assessments are correct. The other thing is, when you weight things, it doesn't stop you investing. There could be a factor like regulation that we would have in our system, and you could score very low, but you could still get enough of a score to be an A, and we would invest. But sometimes the factor's so important you shouldn't invest. So you need another filter, which is just, these are veto reasons, not to invest. And so we have a risk checklist. So a rating system, checklist, and the beauty of the checklist is you can keep adding to it. So the checklist is now more than twice as long as it used to be because of all our mistakes. Every time you learn from a mistake, you can put something new onto the checklist. So the filter gets thicker and thicker. It learns. So that's the system that we've run and applied, and we kept applying it in the same way. So people ask me why you just do the UK. I mean, we're not, our mandate doesn't stop us to do other countries, but we're trying to apply the same system as much as possible. I think, is it in Super Forecasters? No, it's in it's Thinking Fast and Slow. He talks about expertise, and if you hear the psychologists talk about expertise, Kahneman thinks in financial services it's just too spread to become expert. There's just too much stuff. Bonds in Latin America and what's happening to interest rates in Japan, that nobody could ever become expert. But when he got together with Gary Klein, they agreed that you could be experts because he studied chess players and paramedics, people doing the same thing again and again. If you could define the parameters and have a good feedback process. So that's what we do. Try to apply the same system to broadly similar opportunities again and again, and then learn through continuous improvement. So the other thing is that we found a lot of our mistakes happen very, very slowly. They don't just suddenly go wrong, they drift and we don't realize they're drifting. So we have a roadmap. At the beginning, we write out 10 years of what we're going to expect from sales and profits and capital structure and management. And we look at the whole world as it unfolds in terms of, is it on or off roadmap, that piece of news? Because we know there's noise. We know that things don't unwind in the straight line of the model that you put on. But we ask ourselves about every piece of news. Is that sort of within the range of what we expected in our roadmap, or is this off roadmap? In which case, we've got to be honest with ourselves and say the world is unfolding in a way that we didn't expect. Stop, have a think, are you making a mistake? And these are all just tools to try to make you less human in your decision making. So these are all sort of trying to take what we learn from behavioral psychology and apply it to our investment decision making. So we would look at every finished investment and try to learn lessons, improve the system, and add it to the checklist. But when we looked at our system and said, okay, does it do the job of taking all of those learnings from behavioral psychology and putting it into the system? Does it correct for all of the biases? Well, when we did that exercise, so one of our analysts spent a year studying that, we found some flaws. And the biggest flaw was after we own something. So you can build a really good system before you buy it. You have the filter to stop you. But when you own something, this is when problems creep in. So endowment bias, essentially, is what it's called. So to correct for endowment bias, we introduce something else. So within every 3 years, every stock is effectively, it goes through a process to see whether we would buy it again. We call it a debate process. I could talk about it later. It's a very structured thing, but it was something to say, even when you own it, you've got to kind of shake it back up and put it back through the system again. So this is our continuous learning system. And so, yeah, I would say we've got better through time. This is that win-loss ratio, because you need takes time to evaluate when something's finished. There's no finished holdings after 2015, but our error rate came down. This is the error rate by value. And what's interesting is that the big bad years are just at the top of cycles. The time when you're most likely to make a mistake, so 2001 just going into the 2002-3 downturn, and 2006 before the downturn, that's when you're most vulnerable to making mistakes. The starting point for the market is high, whereas in the last, since 2008, the market's been generally going up, and our error rate has been very low, or zero for closed positions. So. This is the numbers I talked to you about. You can see how our ratio has improved. This is comparing the first 10 years and the second 10 years. And this is our returns. They've gone from 10 to 14, but the alpha's gone from 6.6 to 7.2, but also on much bigger sums. So usually managers' track record is sort of the alpha deteriorates with size. They get more skillful, but they also get more popular. We've been very bad at raising assets. That's Steve's fault here, and so we haven't outgrown. No, we've been very disciplined. We put a cap on how much capital we raise. We are concerned about not having more money than we can cope with. So should I carry on through these lessons, or do you want to stop me? Okay.
One more, yeah.
Well, I suppose I see. So one of the things that is not talked about a lot is portfolio construction. And I have that as another sort of point on its own. We don't sort of do it, but sizing, how to size an investment. There's very little on that, and so I've been through a sort of a learning exercise of that. But it very much matters a lot that the sizing reflects what you know about the stock and the opportunity. And so I think that we have a very big difference between our biggest and our smallest holdings. So it's not. So this 75% of our returns have come from just 10 holdings. So out of the 95 investments, because when something's been really good, we've made a meaningful investment in it, and then we've tried to capture that and run that. And our returns on our alpha would be so much less if we even weighted. So recognizing when you know a lot, and I'll give you all the factors we put into that. But knowing when you're very confident and the range of outcomes is very, very much in your favor, then that's worth being very significantly invested. Whereas other times, just because you've got cash doesn't mean that you should make a meaningful investment because the opportunity or how well you know it isn't there. And I suppose these are some of our big investments. So you can see the cumulative effect. And when we have got investments that have gone wrong, they haven't been big losses. So spotting them when they're losses and getting out of them, spotting them early and being able to we don't spot them very quickly, but we try to spot them before they may be clear to the market and try to recover as much of our money as we can. So, but also when you're making investments where the risk is higher or you're less certain, well then they're not as big. So we found that our errors tended to occur when we were widening the circle of competence. We've all got to widen the circle of competence, otherwise we start with zero. So you're always pushing it out. And we just found disproportionately 80% of our errors occurred when we were widening the circle of competence, but there was no other factor. So we didn't know what it would be. So we've had a rule where when we're first going into a sector or a new area for the first time, we just limit to 3% how much money we can put in it, no matter how confident we are. And that, again, is just to protect you from your lack of knowledge. So those are some of our ideas. So we use something, if you've read Fortune's formula, then it talks about the Kelly criterion. The Kelly criterion is great as a betting system if you're doing sequential bets. It tells you how much of your stack, you should be putting onto each bet. And essentially it's edge over odds. So how much edge and what are my odds of winning? But what it's saying to you is when your outcome is very, very positively certain, skewed certain, you should put a lot of money in. But when I try to apply this to single stocks, we'll end up with numbers like 70% on a holding, which we can't put in a stock. And it doesn't work for when you run a portfolio. So mathematically, it's not solvable at the portfolio level, but the theory behind it is good. The more certain you are of the outcome, the more it's skewed in your favor, then the more money you should. So I would say we use a capped form of the Kelly criterion. And it's worth knowing about what it is and how it applies. So these are the 5 factors we use. Upside versus downside. The IV range, especially where the bottom of it is. So if our range of outcomes, if we have a holding that's where the current price is below the worst outcome, liquidation value, then we'll be happy to run a very big weight. But the moment that very big weight goes inside the range, where some of the outcome could be a loss, we get less comfortable with that. So that's a point. So confidence. So how confident we are, which may be because we've known it for 10 years or we all have all the information that we need to know. We know the management very well. How confident. Transparency. So because of our monitoring programs. So if we can see the company, some of the businesses, we've been able to see almost their weekly sales. We can see them. We can see inside the businesses because the extent of our monitoring programs. The more transparent they are, therefore we would spot where things are going wrong, the more comfortable we would be about running a big position. And then opportunity costs. What are the alternatives? What could we do with the money? But that guides our position size. And we've had things where we've run weights have gone up to 30 or 40%. Obviously it makes the fund unmarketable and makes some of your clients uncomfortable. But if we've had a weight of 30% run on the same stock for a couple of years, but it was always trading below liquidation value. So it didn't feel very risky to me. We could close the business and double our money. It didn't matter that it was 30%, and we knew it inside out, and there was very little risk that we got it wrong. So that seemed appropriate. Normally, 30% would look like a mad weight to have. Okay.
Yeah. Okay, you've already teased us with the portfolio construction, so please,
well,
Gary.
It says, look, we don't do it, just so you know. It's not a big one. It just constructs itself. So there's no big insight there. We don't try to construct it.
Yeah. Okay, and we've talked about the sort of what's your investment philosophy, what are the criteria, and what's your approach about intelligent investing. So let's talk a little bit about history and how it has unfolded as Phoenix, because we've seen in your track record that you've been managing for more than 2 decades. So how did you leave first the dot-com bubble, and what did you learn from that period?
So that was I went straight into that 1998 at the end of the dot-com bubble. The way we invest is we don't look at other managers or I didn't look at other managers. We're not in this financial, we're not sat around there. It's a very solo. We don't take any research, and so I found it extraordinary, the dot-com bubble. We were starting the opportunities. We tend to go where the opportunities are. They were food and beverage businesses. They were getting hit because they weren't internet companies. To be honest, in the 21 years that we've been investing, that was the easiest time to get alpha, and I didn't know that. I know that now, but at the time, I was so 2 years in, the fund was back below where we started. So when I started Phoenix, I put away enough money to live for 3 years, and with a little bit of a cushion, and then the rest of the money in the fund. And my idea was, in 3 years, you have a track record, you have a business, or I'm going to have to go and find a job. And so 2 years in, the fund being back where you started, and everybody else was making money and we were underperforming, it felt actually pretty miserable. And so it was just me, and my partner was the marketing person, so he wasn't there all the time. It was a pretty lonely experience, except the opportunities were so good. So normally in value investing, there's a problem with the company. If something's really cheap, usually it's obscured. But these weren't obscured. We could buy Diageo on 10 times earnings. And it had some other things that aren't there now, Pillsbury Doughboy, and it had Burger King and stuff, other businesses in it. So it's slightly obscured, but businesses that the reason why they were down was not because of anything intrinsic to them, it was because of the market and the distortion of capital. And in the UK, we got a sort of a super distortion because Vodafone bought Management, and that doubled its weight in the index. It was already the biggest stock, but it doubled in size. So every index fund had to raise that money. So it went from a 7% weight of the index to 14. So everything else was sold. So it actually allowed you to predict the low point of the index, which was February 2001. So so for us for us investing, it was actually a great opportunity from what we could buy, but it didn't feel like that. It was hurting our track record. I discovered a publication called the Outstanding Investors Digest, which I think has stopped now, but it was a lot of great value managers talking about their experience, and I heard all these other people going through the same thing, and it just felt so good. For all of that not wanting social proof and not wanting to listen to the crowd, I found this small group of people suffering in the same way because they were applying a value. But these guys with great long-term records, and obviously Buffett was going through something similar. It helped to hear, but it was quite hard because it was right at the beginning of my career. But we added great value. The things that we bought during that time ended up adding significantly to our future alpha. We came bouncing out of that with great returns. And when I look back on it, it was a no-brainer for anybody with a value-based approach. Would have happened, but a lot of value guys never made it. They lost their jobs before it turned, and some big names in the UK in value investing lost their jobs. We got our first institutional mandate because a great value guy lost his job, and the money got reallocated to us. So that was that.
Yeah.
That was the point.
You have something to thank to Mr. Market, I guess.
Yeah.
He was telling you constantly that you were wrong, and still you made it out of that situation.
Yes.
And it seems like he himself was the one that provided you one of the greatest opportunities in the market. Do you think so?
Yeah, I think that was one of the great investing windows because you knew what was going on. You knew it was a bubble. I had an investor who was going to top up a lot of money for me. He's still one of my significant investors, personal ones, and I could say when the day it would happen. I said, look, on this day the index is going to change. Our fund got down to 900. It started at 1,000, and that was the low. It's never been the same level again. So yeah, we could buy wonderful businesses trading at very attractive prices, and they weren't hard to find. And it was merely because the market, all the capital being distorted towards dot-coms, and you could see that was crazy. You could see the thinking was crazy. No, there wasn't. It was a mania. People didn't understand the value of those businesses. They were caught up in a bubble. So I suppose that was the best window of opportunity we've had to create alpha.
Okay, so a couple of years go by and 2008 happened. So how did you live the previous years to that? And also, again, what are the main lessons that you got out of from the Great Recession?
So our style. So what I suppose I learned is in that first opportunity, we ended up buying more names because there seemed to be loads around. So we were able to add lots of great names. But the problem is when you add a lot of great names and you haven't developed the sort of expertise that we would now develop, is when you come to running them. It's easy to buy, to say, well, that's at least £1 for 50p or 40p. As they start to run, you start to trim them. Now, what happened is you've gone straight to 2007-8, but there was another window with the Iraq War in 2003, where all of those .com, so that the opportunity went from being food and beverage and defensives to the TMT burst. So we ended up, so what I came out of that was focus on the very best opportunities, get really, really close to them, confident, and then have a really big swing at the best ones. And we ended up investing in Reuters, especially Reuters in the 2002-03. So it was a previous darling of the .com bubble, and it was trashed. It had been £17 and it got down to 90p. And we got very, very close to understanding it very close. I got close to Tom Gloser, who was the CEO. We weren't a huge fund, but it was so beaten up, it was still in the FTSE, that we managed to buy 3% of the company. And we understood it very, very well, and we put 30% of the fund in it. So very, very concentrated. And I suppose that was the lesson I took there into the credit crunch. And I'll tell you, the lesson, I had a new lesson in the credit crunch. And then that set us up for a very good run. We made a series of mistakes during the good times. So we'd always wanted to be sort of Buffett, Berkshire Hathaway style investors, to buy whole companies. And we'd had a situation where we'd owned 20% of Hamleys. It was bid for, taken over, and we couldn't do anything. We didn't want to be taken over. We didn't want it to be gone. And I'd been practicing with my own money on private companies. And I wanted to kind of bring it together. So I changed the rules of the fund after 7 years. But in order to sort of be able to take control positions, you need more permanent capital. So I tried to get control of an insurance company, trading at half its cash, had a long proxy battle. During that proxy battle, Katrina came along, blew the company up. It lost its credit rating. This took a lot of work. Eventually, by 2008, we got the original money back. But that took up a lot of time, but also opportunity costs. Time and capital was spent on something called Goshawk, and it affects our record. We went through sort of by the time the credit crunch happened, we'd had 3 years of underperformance. The other thing that happened to me is when I came to a new sector, a new opportunity, after getting through that, we rushed into it. So that rule I told you, the 3%, that's new. We went into a sector, we thought we found something new, and because we were sort of keen to get on and move on to something new, we put 15%, which is our into 3 different stocks in what was online gaming. And we went straight into the US ban. Yeah. So we just had a series of disasters during this period. Now, the backstop of all the stuff we bought in 2003 was doing wonderfully. So Reuters went from £1 to £7. So the fund was, we were making money, but we weren't making the money we should have been making. So we learned a lot of lessons during that period. Sometimes what happens is good performance lowers your guard. It makes you more likely to make a mistake. You're much more keen when, like you said, when things are down, markets are offering you an opportunity, it hurts. Your fund's down, your stock's down. You look at things really, really closely. You're afraid of making mistakes. When you're making money and it's going well, you're just much more likely to make a mistake, I think.
Yeah, that's right. And also, you've talked about some examples. I don't know if you have some slides for those, but I think you do, for some of the examples that you've mentioned right now.
Not the historic ones. I don't
know, Games Workshop or something.
I don't have a slide for Games Workshop. But that comes as not being able to run a winner. I do have something about our biggest flaw, our biggest weakness, I would say, amongst all the things that we have, is the ability to run a winner. Yeah. We've got better at it, but it's still the weak point. So in the first 10 years, we did some analysis after the first 10 years and what we were trying to do is look at how good our intrinsic value estimates were. So because the portfolio changes, every 3 months we published the intrinsic value of the whole portfolio. So what I wanted to know is what would happen if we hadn't changed the portfolio? Would it move to intrinsic value? So we did that analysis, and it was quite good. It showed that the portfolio tended to move to intrinsic value. It would have made about 15% per annum. So, but all of those years were better than what we actually did. So we could have done nothing for 9 years and done better than what we did, or nothing for 8 years or 7 years. So what we were doing was subtracting value. Now, what we always thought we were doing is moving the intrinsic value up, creating future value.
Yeah.
But when you looked at it in detail, what we were doing is moving on too quickly. Now, all this work to establish a position is something you knew very well. It starts to work. To me, I'm drawn to the next car crash. Yes. And the money would come out of the now it's working into the car crash. And it's much more likely in this one that you're new to it, you're going to make a misjudgment. And then this one is actually, so what we did was we modified the way we sell. So Games Workshop there's a lot of slides through to where that is, but it's a case study in us throwing in the towel slightly too early. So what we do is we use a different intrinsic value for selling. We use an intrinsic value for buying, but for selling we put back in some of the things that when you're doing a buy, you take out all the nice, the fluffy and stuff. You focus on it's at least £1, I'll pay 50p. For selling, we put back in the possible, what that might be, what's the range of outcomes, and we come up with an intrinsic value. Also, we look at the qualitative. So is this looking like a great company? Is this looking like a great management? And that would allow you to run it much closer to intrinsic value. And that's got us much better. In the second 10 years, we were much better at running our winners. But yeah, Games Workshop accumulated a position at £1.75. The business has paid out in dividends since we've invested probably £6 a share. But at one point, when Tom was stepping back, the founder, the new CEO was just taking a bit long for things to happen. And so we ended up sort of £6 trimming a lot of our holding. And then the shares trebled. And we then sold, but because we'd sold so much of it, we didn't have a big enough holding to justify the work that we would need to do to keep on monitoring it. We sold the rest of it at £27, and now it's £45. And what happens, we identified a great company, it was a great company, we bought it at a great price, it's been paying out all of its earnings as dividends, it was easy to hold, and we don't own it. And it hurts. And I'm friends with Tom. Every so often we write, and he's not nice. I mean, he's right. But
he shows you the graph, or
running winners is the hardest thing. But ultimately, what our data would say is no selling at all would have been better than any selling. If all we did was just do no selling, then that was a better strategy than what we'd done. Yeah, and I think a lot of managers have the same problem.
Charlie Munger always says, the money is in waiting. It's not in either buying or selling. Well, yeah, of course, there's some money
waiting
there,
before you buy, being willing to wait, and we're very good at waiting. We recently bought something we waited 13 years to buy. We're good at waiting to buy. What we need to do is, and we try to be better at not rushing to sell. We learned some lessons out of that, and we've applied them. We had a holding that would have been similar, where we might have trimmed. We took the lessons from Games Workshop, we've applied them, and we haven't sold the holding. So I think hopefully we've got better. We'll do a lot less selling.
You've already talked about the work field process that you do for analyzing the companies. Can you talk us a little bit more about how does that work? How much time do you invest into analyzing one company before it goes into your portfolio? How does that process unfold for you? As a team, you've also talked about the debate part and also the post-mortem, which is really interesting in terms of how do you analyze your mistakes and learn from them?
I would say in the team, most of what we do is monitoring. So the biggest part of the assumptions when you model the future is sort of the competitive dynamics. The thing that's going to mess you up is the world is not going to unfold how you want it to do, because the market's going to be different. It may be the demand profile changes, but most often or not, it's competitors that mess you up. Competitors and management. So we focus a lot on those risks and by monitoring them very, very closely. So most of what goes on in our office, I would say 3/4 is monitoring. And it's wherever. So if we own EasyJet, we're monitoring all of the places where EasyJet competes with its competitors. We'll be every month stripping prices and comparing them to see what's going on. Berlin Airport, where there's a battle going on at the moment between EasyJet and Ryanair and stuff. We are monitoring that continuously. So most of the work is like that. We own Wetherspoon's pubs. So every month we strip all the data from their app, so we can see all of the prices they charge, and they have different prices. We know when they have a difficult pub, they lower prices. So when they, I mean, I have some slides for that. Where we, maybe I'll show you some of that.
Yeah.
Let me show
Sure.
you. It might be easier because it's probably slides sort of. I mean,
Yeah, that will be really
Yeah,
instructive. Yeah.
I'll,
I think that. Yeah, that's the Games Workshop part.
Yeah. Okay. Yeah. Do you want to see that game? And that doesn't even give you the sense of where, that's after we sold. We sold the last bit up there. Since then, that's £26. It's now £45. So, yeah, it's.
2 years, less than 2 years.
Yeah, but
I
we'd
think.
owned it, for 12 years. I mean, it was not a. So this just look at some little examples of our.
Mm-hmm.
So we own Sports Direct. We monitor everything. We've been for 10 years every month a basket of their stuff against all their competitors.
Mm.
Amazon, Decathlon, eBay. So they've always been able to beat Amazon every month. There's very few retailers can beat Amazon, and then they make a 25% return on capital. Amazon doesn't. But they started a new strategy. They didn't tell anybody. So this is a store we knew was part of the new strategy. They were trialing 3 or 4. So we would figure out, our analysts would figure out the economics. So they put every lease into a separate company so we can work out what they... So what happened was the analyst was able to go, and we kind of figured out that capital allocation decision, what they paid for it, what they'd done, and we continually visited there. There was a gym, so we'd work out what it was making, and we've been checking the membership numbers of the gym, and so from that we were able to see they were making a 24% return on capital. And they did 4 of these before they announced it was going to be a rollout strategy, but they never said it was working. In the announcement they would say, we're going to be Selfridges as a sport, we'll try it, we don't know, it's kind of a gamble, and then the market worries about that, except we have this because we're visiting them, we know how they're doing, and when we talk to them we test these assumptions, we have a good relationship with them. But that level of detail, how many gym members, by going back to the store, collecting that info, I mean, to figure out the square foot, they obviously wouldn't tell us that, he paced it. He sit in the car park, see how many car parking spaces, we watch how many customers come. This is what my guys do. They go out on the field and they study. So this is one of the sort of desk bound work. So we have one of our hypotheses is that Ryanair and EasyJet don't compete with each other, and so we plotted every single route in Europe that they're on, and the red ones are EasyJet and the blue ones are Ryanair. And so what it shows you is that there's very little overlap. So when you look at a country, it's like this. So this is between UK and France. So there's only 2 routes where they compete. You think, okay, they're both flying between England and France. There's loads of competition, but actually, if I wanted to travel between this airport and this airport, I've got one or the other. I haven't got both, and that's because EasyJet is in the slot-constrained airports. It's in Gatwick. It's not in Heathrow. It's in Luton, places where Ryanair can't come. And so it's a different franchise. They get a different type of customer, a customer who wants to fly convenient airport to convenient airport. So we test this. We run this every 6 months. It's a lot of work. The analyst does it, and we look at where it's changed. So when we see where they're opening routes, closing routes. But that's the overlap. I mean, this was the time when this slide was done. We do this. It's moved on a bit from here, but it's very, very. Everybody thinks they do 40% of all the air travel within Europe, and yet they almost don't touch. And where they do touch, we follow it. So this is so Wetherspoons. We used to pay students. We would pay. We'd have like 20 different people going to pubs, and we'd pay them to do a review. We give them a voucher so they could have a free night out. But we have to photograph the toilets. You have to take the menu. We would get very varied responses. So then we moved to TripAdvisor. So we stripped the TripAdvisor because there's a lot more information there, and we built an index using TripAdvisor. And then the latest thing, so a new analyst, what he's built is he strips is a bot that every month it takes all the data off their app, and there's lots of information in there. So one of the things is the prices they charge, which we know are different. And so someone wrote this article. We tried to get the information from him to start with in the FT. Yeah, he'd done it manually. So, and it wasn't that useful. So that's why we developed our own. So we've got over 2 million rows of data at the moment. So here's just an example. So this pub, we can see that so we see whether they're raising or lowering prices. They're lowering prices is a sign the pub is not performing well. That's their thing. They need to get customers. So then he would visit there, and he visited it, and he found that there was a new competitor, Craft Union, across the road. So that's what we want to do. We want to look at when competitors come, what happens. So this craft union has cropped up in a few places. We see what happens. We keep going back to those places because we want to spot it going wrong. Our assumption is they've got a strong franchise, they're the low-cost providers, and they've got pricing power from being the low-cost providers, and they've not beaten on price. So we're looking for signs that our hypothesis is wrong. And that's a lot of what we do. So, you know, this we can see also at a grand level, 80%. So it allows us to monitor what's going on inside of Wetherspoons through the app. So that's mainly what they do. When it comes to a new company, what happens is I do the original work. No, someone can come up with an idea and propose it, but it's usually more often would come from me. Because my filters may be more developed, I'll get there quicker. And people are coming up with ideas, but I then co-opt one other analyst, and then they go and build their expertise. I would say that usually takes them 6 months, because they'll go on the road, they'll go and meet competitors, go and meet trade journalists, you know, people who run.
Yeah, pay students.
Yeah.
Those kind of things.
And then when we have enough information, then we'll approach the company. If it's still looking like it's a candidate, then we approach the company as like the final thing. We go to the management when we're already experts. We don't want to go and learn from management. We want to go there last. So when we've heard from their competitors, we try to find employees, disgruntled employees. So that's the work that my analyst was doing, who got told off. He was pretending to be a franchise. He was inquiring about franchise, and he was using he was using his Phoenix email, and they could figure out who he was. But those things sometimes happen. So, and then it goes through our process. We do the dream, and then we work. So what we try to do is find a good business and a good management, because the price is something that will come later. If we wait for when things are cheap, it takes us too long to become expert. So we collect things where we're happy with the business and the management, and we know the price, and then we wait. So our biggest holding, one of the biggest holdings recently is Dignity. We waited 13 years until it came into our price range and it fit, and then we started buying it. But otherwise, it was just in our system as a AA, waiting for it to be a AAA.
Yeah. So your watch list is really long.
No, it's very small, because it takes a long time to get that level of expertise and to keep it. So in total in our system is about 100 names, either in the fund, but sometimes they're a single A. It's a good business, but the management's not good. We have we do the work and we say, actually, it's not an A for management, it is an A for business, and we wait and see if the management changes. And then if the management changes, then it's possible it could become a AAA, you know, with the right price. But no, that's the extent of it for the moment.
Okay, I see. And you've also mentioned that the fund is basically a UK fund. So we keep going a couple of years later, and after 2008, I guess Brexit was a really big thing for you. How did you cope with that moment, and what's your expectation about Brexit, and how would it affect your portfolio?
Okay, well, let me at least tell you about the credit crunch, because that was a big thing for us. And I suppose what I learned in the credit crunch was we had too much concentration. So can I tell you about that? Because I think it's
how much concentrated were you then
so
compared
when I
to
told
now?
you the lesson I took into 2002, where we put everything into Reuters, was that in those big drawdowns, you only needed two names. You know, you could put and at that time we could put up to 30% at cost, because obviously things halve, and well, you don't want to halve, but then you're doubling up. The actual weight is coming down, but we have a limit on how much it cost. And our limit used to be we could go all the way up to 30% at original cost. And so when we went into the credit crunch, the opportunities were in banks and house builders. And there is something maybe I could tell you, because this was a big lesson for me from the credit crunch, because it probably tells you something about where we come into Brexit. I have a diary. And I have written in it, I think, 7 times in 20 years. So I write when something's really unusual, because I think I just need to record this. I'm feeling sick or elated or something, and I think I need to just write this down because I can come back to it later. So, because I think one of some lessons, no matter how much you read other people's books and listen to them, some you're just going to have to go there, you go through it yourself. Because someone will ask me, is this person going to be a good fund manager, a value guy? And I will think they are, and then I saw in the credit crunch the way they acted, and that cost them. And so this is one of my things in the credit crunch. This is a diary entry. So this is the middle of June. I am feeling pretty sick at this time, and so much so that I actually think I need to write down how I feel. My wife even sends me an Indian head massage. My wife's a psychologist, so she's very sort of attuned to my me. She used to be a currency trader, so so at this point she thinks I need an Indian head massage and to be loosened up. And I come out of this massage and I bump into one of my big investors. But anyway, I wrote this down. So after February, when Bear Stearns failed and then was rescued effectively through the JP Morgan deal, I thought that was it. So we were effectively all in. We made our sort of our almost maximum allocations in this period now that's coming on post Bear Stearns. So when Lehman came around in October, we'd already made our allocations to the cyclical. But this going on in what was our biggest holding, was in house building. Now we've been in house building on and off since 1998. And what happened was, I'm writing here about Barrow. I have the feeling of being right out on a limb, which means that if we are wrong, then the consequences are dire for me and Phoenix. After a poor run in the past 3 years, a mistake of this magnitude would destroy my credibility and lose us a lot of assets. Not least, it would severely shake my confidence in my own ability. So this is me. This is rock bottom.
Wow.
So this is not only my investors, if this is wrong, will lose confidence in me, but actually I will lose confidence if I'm wrong about this. And that's kind of how it felt. I'd enjoyed all the drawdowns up to then. Like Christmas, it's halved and halved. This is fantastic. We're adding wonderful value, but this one had gone beyond the funny and enjoyable, and it was getting to the point where I had to write this down. I was saying, why am I not enjoying this? I'm buying these wonderful bargains. So this was Barratt Developments. It had got up to £14 a share. We had last sold our last holding at £6. It went up to £14. Did an acquisition for shares at £12. And then on the way down, we'd started investing at £5. And then we got much more aggressive at £3, and then it was at £2. And so this is when I'm writing. It's now £1. So we'd done a lot of our doubling up at £2 and £3. And we thought when we were doing £5, what was the worst it would get to? So £5 was asset value, book value. So, but it had gearing. So we knew it had gearing, but house builders in a downturn don't have a problem with liquidity. They generate loads of cash. And we monitored Barratt so closely, we could see every house they were selling. So we were monitoring, they had 400 sites, and we were monitoring 280 of their sites, every house they sold. So we were just stripping their website, and we could see the plots being sold. We were visiting 70 of those sites just as mystery shoppers pretending to buy. So we knew exactly what their sales rate was. And actually our data was quite close to their accounts. I mean, they would have a joke at the time that if their accounting system went down, they would call Phoenix to find out how they were doing. But I'm writing that, it's ugly, they're £1 a share, having been 14 and 5 and 3 and 2. So this is 6th of June. In the next 3 days, they halved again. So what do? You've got this wonderful investment that we think is worth £11 before, based on, and it was that price, and it was that price, and it's gone down. Do we keep adding? So we did add, and we doubled the position again down there, but it halved again, and halving's huge. When you've made something a 25% weight and then it's painful, and everybody who knows that's your biggest holding is asking you, do you still think? And at that time, house builders, people just, the world was full of house price crashes, and the insights we had. The conviction we had was huge. The information we had was huge. There was no worry about it going bust, and there was plenty of cash. The houses were being sold. The way people buy houses in the UK is very different from the US. All of these things, which were correct. But obviously at that time, everybody thought I was a total idiot, and our track record was getting absolutely hammered. And if you wait, it was fine. But if you look at this, this is when I'm writing here in June. Yep. We doubled. They never got that low again, even after Lehman's. So they then trebled. So hero for a bit, then an idiot again. And then what happened was they did a capital raise, and they went sideways for a long time. And we supported the capital raise, but we couldn't match our rights. We'd already made such a big investment, but we couldn't. So we did the capital raise when the shares had recovered, because we were worried if there was a double dip recession, it would be we would have a worse downside. But it meant the shares went sideways for 2 years, and it was a 30% weight. Everybody, and we opened the fund for the first time in 10 years. We went out to say new investment. Everybody said 30% in a house builder. God, it's mad. He said, no, but let me tell you, it's worth, you could close it down and double your money and you do all this. And in the end, it was fine. And so the work was correct and stuff. But this is when you come to this, this is hard to live through. And the lesson I got from that was that it was that our position size was too, because we got no redemptions. So as scary as that was, not £1 of our investors in the fund took any money out. They came to the meetings. You get a big turnout on meetings when you do these things. Everybody wants to hear about it. And people weren't necessarily happy because our peak to trough performance was 50% drawdown. But I suppose what I thought was, why could I not stop the cortisol flooding through my body? Because I should have been ecstatic. Well, it's £1 now for 10p. Wow, that's brilliant. It's £1 for 5p. And so what I determined is our position size was wrong. Because if that was a 0, and I suppose every holding you've got to say, if it was a 0, how would you feel? And I thought, when I was writing that, you could tell, I thought if this was a failure, then I was a failure. I was a failure, Phoenix was a failure. So that's a wrong size investment. You should never have that because it'll interfere. I mean, luckily I stuck to my gut. I've seen a lot of people lose their nerve, change their portfolio strategies, go very conservative down the bottom, and then they never made anything in the bounce. They had the drawdown, they didn't have the bounce back. A lot of value guys. But I've always worked on the basis that everybody leaves tomorrow, what's the right thing, and that's what we did. But I think that was a tough lesson. So we halved our risk limit. So instead of 30, it's 15. The most we could put now is 15, and I think I could ride that. And so when we come into Brexit, we have the right position sizes. I don't lose any sleep about it. Right. I don't worry about it. And in terms of the nature of the opportunity, maybe it's because we're sat in the UK. Maybe it's easier to sort of evaluate it. But that's essentially what. And if I tell you how we think about it, we don't say what's going to happen. We say what could happen, and what's the value of that company if that happened. So we just stress test everything. And when the referendum happened, so house builders, which I think we know extremely well, we know how to value them well. We have contacts with all those management teams of the house builders, but also our monitoring on the ground. We know what's really going on. So those shares halved in 3 days after the first referendum. So we put £100 million into house builders in 3 days, and but what I learnt on the ground was the houses were still selling. Around Fulham and southwest London, there was trepidation. People who were close to financial services were affected. By the time you got to North London, no effect. By the time you got to the north, the World Cup was more important than the referendum. So we could see the businesses were trading as they were before the referendum. The market was panicking, but actually people were still, people need a house because they've had a child, they got married, they've got a job, they're going to buy a house. So the world was carrying on as normal, and we had all the information to say, here's a wonderful opportunity. And Brexit was going to be 2 years away, and we would say, well, what if it's terrible? What if we had a house price crash, and and that's what we do. And I could show you. I mean, I haven't have it here, but we have it. We stress test all of our stocks. What happens? So all of the Brexit scenarios, we test the worst one. No deal Brexit, followed by a really bad recession, depression in the UK. What happens to this business? What happens to that business? So that's what we've done. So we've ended up with a portfolio of very domestic focus because that's where the opportunity is. If you're domestic and cyclical, then money is not going into the UK generally. And if it's not going to anything, it's ones that are very UK focused. So that's where the best value is. Because when we look at the way consumers consume, it won't matter what political union is. So we own supermarkets. We think people were still going to eat when we leave the EU. And the way they're going to eat is still pretty similar. It won't change. And we've seen how they ate through the credit crunch. And they carried on eating through the credit crunch. And we think they'll carry on eating if we leave the EU. But if the currency goes down, then what happens is food prices will go up. But people don't change how they eat, the amount they eat because of higher food prices. They take the money from somewhere else. So supermarkets are actually more valuable if you have a falling pound because they have negative working capital. So those businesses benefit and other businesses suffer, but we run all that scenario. So we have, if our fund price is 6,000 and we think its IV is about 12,000, when we stress tested our worst Brexit scenario, we come up with just over 10,000. So the fund's worth a lot more under normal circumstances. On our worst case, it's still worth a lot more, and therefore nothing to fear. I suppose that's what it is. And I think Brexit, like a lot of these things, is noise. It won't have
Mr. Market again.
Yeah, I think if you think about businesses that are available to invest in today, some of them will be worthless in 10 years, and some of them will be worth 20 times more. And it won't matter whether GTB grew at 2.5 or 2.7 or 2.2. We're not buying the whole economy. We're buying successful business. The thing that will damage the businesses will be competitor, the internet. Some of the businesses will be wiped out. So at the moment, our biggest challenge for most of our companies in some ways relates to the internet. And that's the difference between being worthless or worth a lot more. And the economy is just a real, small rounding error on all of that. So no, I think it's a distraction. It's great. I mean, as a citizen, it's a disaster. As an investor, a no-deal Brexit will be wonderful. There'll be blood on the street. The market will be carnage. There will be wonderful opportunities to invest.
Right. So we've talked about these 3 periods of time, and now we're sitting today. Do you see any similarities with these periods of time? Do you think maybe fourth quarter of 2018 we've sort of seen again Mr. Market with his mania giving great opportunities for investors?
It's not like so the ebbs and flows that create opportunities. This is not like the opportunities of the TMT bubble. It's not like the opportunities of 2008. It's not remotely close. So the UK creates opportunities because it's an unloved market. Equities generally, though, are reasonably loved. Because bonds are so expensive, then equities have something else to pin their valuation on, but they're not wonderfully attractive. But the UK is more attractive. So we find opportunities in problem companies, not general. So yeah, they look like cheap stocks in retail, but retail is really difficult right now because it's changing. So is it really opportunity? I'm not sure it is. So I don't think that. We don't do macro forecasting, but we do. I suppose what we would say is that the economy has been growing for 10 years, and therefore more probable than not we're about to have a downturn. It's not a forecast, but we know that on average upswings is 8 to 9 years. So on average we would be due a recession. It's not a forecast, it's more probable than not. And every year that we grow is more and more probable that there's a downturn. So when we value businesses, we value them with a recession next year. So we start with a downturn. We don't start with an upturn. So when it's the credit crunch, you can value them assuming an upswing, because it's just more likely than not when you're in the middle of a recession that you are. So right now you've got to assume that we're heading into a downturn. Now, just the earlier it is, the milder it will probably be, but we don't have any forecast. We don't know what will happen, but I suppose, I don't think it's anything like those windows of opportunity. I think it is more the other side, maybe stocks of some reasonable value. But what I do see is when companies are having problems, they get really hurt. And so our opportunities have tended to all come from companies that are having problems. I mean, most value, you've got to see the world different to what the market's. So that's usually when there's problems, there's too much weight put on short-term news, and there's not a long enough perspective, and you might be able to find something. But no, I wouldn't say the market's wonderfully full of opportunity generally. In the UK, domestic is more of a pool of opportunity, and within there we can find some very attractive businesses.
Okay, great. We will start with the Q&A part of the event now, and you can raise your hand, and my colleague Irene will give you the mic to make the question. Do you have any question? Okay, then I will give you one more question before we wrap this up. And what do you think about passive investing and the current trend in the change of assets under management growth for active investing and passive investing? What do you think about the effect of passive investing in the future landscape of investing, and could it generate more inefficiencies for active investors, or do you think it's the other way around? You might have to wait way longer for those inefficiencies to really disappear, and most of the capital allocation is going to be dump.
So I suppose, I mean, there's lots of stuff in there. So the passive investing doesn't compete with the active investors. So that's always been the case. And there were a lot of active investors before who were kind of passive because they were so widespread. They might have called it active, but
yeah, Peter Lynch, for example.
Yeah, they weren't really. But those weren't I mean, a lot of active management fees have been poorly earned because 90% of the portfolio was the index. And so the actual piece creating alpha was very, very small. So I don't think that's I mean, it's a smart way for people not to choose a manager, is to choose an index fund. So I don't, the pool of opportunity comes from what happens to companies and how the market interprets them. And it would be different if lots of the managers were all going to index, but they're not. The money's going to index. So if there's 100 people trying to find opportunities, that's our problem. So how many active managers are there? That doesn't seem to have shrunk. The fact that lots of the capital goes into index fund, that doesn't matter. They're not competing with us.
So that's the retail part.
The problem is how many people are trying to spot opportunities. If there was only one value guy, well then great. But there are plenty of people with a value focus, and now there are quant funds who do value, who shortcut value, which works. Which you know, if you just use some of these metrics, you'll be able to create so I don't think it's going to get easier. The opportunity, I suppose, one of the surprises for me over 21 years is when I started, I thought our opportunities would be small caps. I thought the fact we go out and do real work, we will find opportunities in stocks that analysts don't cover. What I didn't realise is your analysts are the best friends for finding opportunities because they're just human, and they're particularly poor at sort of predicting value. So the analysts are caught up in the way that they're structured. So we've actually disproportionately had opportunities in bigger names. I don't know, Steve would probably have the percentages, but something like, is it 30 or 40% of our things have come from FTSE 100 names? So I would, you know, that's 100 out of.
How large in market cap would that be?
It's just that there's 100 of those out of 2,000. So they're 5% by number, but they're nearly half by value of what we've done. I mean, to get into the index now, you're probably talking £4 billion or something. But it's so the opportunities come because of human psychology. So people might be in index funds, but what do they do in a downturn? Do they panic and pull their money out? Well, then those index funds are sellers. But they were pulling their money out of closed-end funds or other funds anyway. And it's that human psychology, which is fear when things are bad, when nobody wants to invest, that creates the opportunity. Money gets sucked out of the market, but it can't be sucked out because it's a closed end. You can't take your money out of the stock market. People say money came out when it can't. When you sold, someone bought. So the clearing price went down. And so those things are still going to happen. And so that the reason why we get opportunities is because of human psychology. That hasn't gone away. And the reason why it's hard to find value is because there's loads of really smart people doing, this is not helping. What are you guys doing? You're creating even more competitors for us. So
Sorry, Gary.
There's lots of smart people looking for opportunities, and they can get capital, they can build track records. So I don't think indexing is going to help us. At the margin, it creates this little opportunity because sometimes the distortion of going in and out of the index. That's a game you can play, an arbitrage. But otherwise, I don't think it changes the game too much.
Okay. And now, this is going to be really the last question. So please give us 2 book recommendations. The first one, an investing book, and the second one, any genre you might feel that might help an investor today.
I mean, given this is sort of on record, rather than just giving you an obscure book, I will tell you the books to me. I've always say if someone had to just read 2 books to be a good investor, then I think you have to read one book that's on psychology. And so you can't get a better book than Daniel Kahneman's Thinking Fast and Slow. In terms of your bang for your buck, there's a book called Thinking Clearly that distills a lot, Dobelli, that distills a lot of those lessons into a much more readable book. But Thinking Fast and Slow is the Bible that gives you the psychology. And then again, there isn't a better book than The Intelligent Investor. I read it every summer again.
Chapter 8.
I read the whole thing. I never. But if you want to go a bit more obscure with Graham, then I think the second edition of Securities Analysis, not the latest one, not the first, the second edition, because if you can understand how to invest in bonds, the way you have to think about for that gives you a very good grounding as an analyst. So the second book. We have hundreds of books on our site. We read lots of books. A book I'm reading at the moment, which just came up at Buffett's meeting, is Railroader, about somebody who transformed. So I suppose that's what you like doing, reading stories of people transforming businesses. But what Kahneman will say to you is, you've got survivor bias. The books that get written are the books about the winners. Nobody's writing the books about the losers. So every time you read one of those, you need to read a book about failure. If you're going to read a book about Amazon, read a book about AIG to try to balance it out. So there's a book about the Davis dynasty. I'll give you the exact name and the thing. But the Davis dynasty, this started with a guy who is very much, we're probably, if you looked at our investment style, it's like Phil Fisher. So the book I give to people most often is The Common Stocks and Uncommon Profits. Read that book. That's the closest to our style. But there's a guy, Shelby Davis, who started off, he was an insurance commissioner, he became an investor, he was a single guy, he knew about insurance companies, but he had very, very focused portfolio. He built up his whole pot of capital from his own money. And eventually that's grown into a Davis Asset Management Advisor. They're 100 billion, they got to, I think, a peak 100 billion under management. Third generation, focusing on financial services, and then they came unstuck in the credit crunch. But reading about that, so his way of investing as a person when you're starting, just basically the advantages you have as an individual to go and get more information, to go deeper, to be just your own primary research engine, that then I think is as a starting point. And that's quite an inspirational book. It's about the Davis dynasty, and I'll give you the name of that. That may be something that people haven't read.
Okay, that's great. Thank you very much, Gary, for your recommendation. Now, here at Valley School, you've said we're helping, well, we're not helping you exactly, we're helping other investors to invest better and helping to spread financial education, and you've also helped us with that. And as you might also know, each one of our guests come here disinterestedly, so the least thing that we can do is just give you one of our books from our collection. This one is Invirtiendo a Largo Plazo, which is Francisco García Parames's first book, and we also have it in English for if someone is watching us from home and he wants to have that in English. So there you go, Gary. Thank you very much. And to every one of you, I'm going to quickly change now to Spanish. Thank you for bearing with my broken English. Gary was perfect with his. So, bueno, nada más que añadir. Les esperamos a todos el próximo lunes 20, aquí de nuevo en nuestra sede, con un evento sobre cómo cuidar e impulsar tu marca o la de tu empresa a través de lo que dices y escribes, copywriting, una cosa esencial en el día de hoy, con José Castro. Y también la próxima semana, el jueves 23, vamos a tener otro evento gestor, en este caso a 3 bandas, con Gemma Hurtado, Lola Yacutot y Lola Solana, 3 de las mejores gestoras que hay a nivel nacional. Y el evento se titula Warren Buffett invierte como una mujer y tú también deberías. Ahí vamos a descubrir muchas de esas claves del éxito de estas mujeres gestoras. Y nada más, muchísimas gracias a todos por haber asistido y por habernos seguido desde casa. Thank you very much, Gary.